In today's video, we are going to break down how a married retired couple here in 2026 can realize over $148,000 in income and pay zero taxes. The other thing that we're going to break down is why it may not make sense for couples in that situation to pay no taxes and why they may instead want to intentionally realize more income and intentionally pay taxes when they may not have to. Welcome to Coupable. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. Cheers. So as I mentioned in the introduction, the primary thing I want to focus on in today's video is a pretty cool tax trick where retired couples potentially have the ability to realize, in some cases, pretty significant amounts of income and pay no taxes in the process. And so I'm going to walk us through a case study for a potential couple, kind of a common scenario that we come across and how it would work for that couple. And so in today's video, we're going to be looking at a married couple, both age 65, who have recently retired and have no income from employment this year. But they have $2.5 million in a pre-tax IRA account and $2.5 million in a taxable brokerage account, and neither of them have turned on Social Security. So in that situation, how do you pay no taxes? So let's walk through a couple of things, and I'll say a couple of these things have been changed or are new from the tax bill that was passed late last year, which we have a great video that you're welcome to check out that overviews a number of those changes. But there's a couple things to know. So one, there is the ability to realize up to $49,500 in ordinary income for that couple this year. And that's from a couple different sources. So one is the standard deduction that every married couple gets, which in 2026, the standard deduction is $32,200. That amount gets indexed for inflation every year. So if you're watching this in a future year, that amount may be higher. But here in 2026, $32,200. In addition to that, anybody over the age of 65 who's taking the standard deduction gets an additional 65 plus deduction, which is $1,650 each here in 2026, or $3,300 total. One new thing that got introduced in the tax bill that was passed last year was the senior deduction. So if you saw in the news the idea of no taxes on Social Security, what that actually ended up being was this new senior deduction, which actually has nothing to do with whether you've claimed Social Security. What it is if your income falls below certain thresholds, you get to deduct an additional $6,000 per person over the age of 65, or for a married couple, both age 65, $12,000. The other new item that was introduced in the tax bill that kind of plays into this scenario is the ability to take a non-itemizer charitable deduction. So for a single tax filer, you can actually deduct $1,000 of charitable giving, even if you take the standard deduction. For a married couple, $2,000. And so in this situation, they're taking the standard deduction, but if they've given $2,000 to charity, they do have the ability to add an additional $2,000 non-itemizer charitable deduction. So when you add those four different items up, we get $49,500 that we can deduct against either ordinary income or capital gains. So, ordinary income, that's going to include if they were working. So if they had a part-time job, for example, or maybe they're making $40,000 a year, working at a golf club or working at the grocery store, or whatever it might be, $49,500 or less of that, they pay no taxes. That could also be interest from cash at the bank or money markets, it also includes IRA distributions. So if they did decide to take any money out of their IRA account, that would be subject to ordinary income rates as well. A lot of people may not know the nuances of that, but most people are familiar with the idea of deductions and using that to offset income. What I found a lot of people are not aware of is the second component to this, which is the 0% long-term capital gains rate, which applies to both long-term capital gains, so investments that are sold after being held for over a year for a gain. It also applies to qualified dividends. So most, like if you own a U.S. stock, for example, you own Apple or Exxon, and you get a dividend payment. Generally, that's a qualified dividend that's also subject to long-term capital gains rates. The 0% capital gains bracket, which gets stacked on top of these other base deductions, is an additional $98,900. So when you add that all up, $148,400 that you could realize if you're strategic about what sources of income you realize and make sure you stay below certain thresholds. You could potentially realize and pay no taxes. A really simple way to do it would be if you sold investments, you had no other income, you sold investments and realized $148,400 of gains. As long as all of those gains were long term, you'd pay no taxes. Now, obviously, if you have investments of that size, you're probably receiving some dividends. You probably have cash where you're receiving some sort of interest from the bank or from money markets. And there may be other forms of income. So that's overly simplified. But if you can keep your ordinary income below 49,500 in this example, and your long-term capital gains stacked on top of that, to below $148,400, that is the scenario that you would pay no taxes. So now that we've talked through that tax planning scenario, I'm going to ask a question that may seem crazy. Why would I not want to pay any taxes? And so I'm going to kind of further expound on this case study example that we've laid out as a fantastic reason as to why we wouldn't want to pay no taxes. And so for this couple, they've accumulated $5 million by the time they've retired and reached age 65. And so we know a couple things about them. One, they have a pretty significant IRA account that there's going to be income taxes due on. And over the course of their career, in which they've saved and accumulated a pretty significant sum of money, they've made good wages and they're going to receive a good Social Security benefit, which is partially taxable. So I'm going to talk through a couple of what I call forced income events that'll help explain why we wouldn't want to pay no taxes in this particular example. And so I'm going to start with Social Security, which I'll say if you are watching this and you've never run the numbers on what your Social Security benefit is going to be, or if you have a financial planner and they've never run the numbers on what their Social Security benefit is going to be, it's a huge planning opportunity. And I'll say something that we do for every single one of our clients who are eligible for Social Security. And it really helps us not only understand their benefit and how to maximize it, but also to understand their future tax situation. And so for this couple, what we're going to do is we've run the numbers on what does it look like if they both turn on their Social Security benefit at age 70. So basically we have a 5-year window where theoretically they could have no income, but then at age 70, they're going to have a pretty healthy benefit that gets turned on. That it's kind of confusing and complicated, the math behind how much of a Social Security benefit is taxable, but generally it's somewhere between 50 and 85%. So in this case, we'll just say 85% of their Social Security benefit is going to be taxable. When we project it out in year one at age 70, $65,000 for one spouse and $60,000 for the other spouse, we're talking about $125,000 of income, 85% of which is going to show up as ordinary income on their tax return. And the way that Social Security works is every year you get a cost of living adjustment that, may or may not totally reflect inflation, but you get some sort of cost of living adjustment, which has historically been about 2.5%, meaning that benefit is going to rise over time and the taxability of that benefit is going to rise over time as well. The other thing we know about this couple is they have pretty significant pre-tax retirement accounts, $2.5 million. And so for this couple, the government says once you reach a certain age, we're going to require that you start taking money out of your retirement accounts, whether you want it, whether you need it or not. You've waited long enough, and now it's time to realize some income and pay some taxes. And so the way that that works is they look at the balance of your account at the start of the year, December 31st of the previous year, technically. They take that balance and they apply a divisor, which is essentially a percentage of the account that's based off of the age that you're turning that year. And so that percentage, it goes up every single year. And then what we typically see in a situation like this is the balance of the account will typically over time rise as well, even though there's some distributions that are required. They're not required significantly enough to offset market performance in an average market performance year. So even though we're taking some money out, we still tend to see the balance of the account go up over time. And so we'll pull the required distribution projector that we've put together for this couple up on the screen, where essentially we've assumed a 6% rate of return. So a conservative rate of return on the $2.5 million balance that they have right now. And by age 75, the projection would be that they would have close to $4.5 million in their pre-tax retirement account. And that would result in a required minimum distribution of just shy of $182,000. So that's at age 75. If we look at their Social Security projector for age 75, we're looking at an additional $72,000 and $67,000 of Social Security benefit that gets stacked on top of that. So we're looking at a pretty significant amount of income that we're going to realize the year that those turn on. And like I mentioned, for both of those benefits, they go up over time. And so that's just the starting point. That's kind of the low point, so to speak, typically on a projection, where I like to fast forward another 10 years. So let's look at age 85. So at that point in time, the projected required distribution is $302,000 and change. And Social Security combined is another $173,000 combined. So when we combine both of those figures, we're talking about over $500,000 of income that's going to be forced upon them, whether they want it or not. And so we'll pull up what we call the tax bracket pyramid, which shows the tax rates for married couples on the right-hand side and single filers on the left-hand side, where we'll see that if a married couple has roughly $500,000 in income in today's rates, they're looking at a marginal tax bracket of 32%, but that also means that they've filled up every single bracket below that. And so effective rate is going to be blended somewhere in, call it the 20% range. But, some of that money we're paying 22, 24, 32% on, and that's operating under the assumption that at that point in time, tax rates have not changed. And I'll say right now, historically speaking, we have some of the lowest tax rates for the levels of income that are associated with them that we've ever had. And so we don't know when tax rates will change. We don't know if tax rates will change, and we don't know what that will look like. But it's a pretty safe assumption to say that the tax rates that we have right now are very attractive compared to what we've seen historically and what we may see in the future. A couple other planning notes I'll bring up around that is, one thing that we know is one spouse typically outlives the other spouse. When that happens, the higher Social Security benefit remains. Generally speaking, the required distributions do not go down. And so if we look at a similar, call it $400,000 of income on the single side of the tax bracket pyramid, now we're talking about 35% marginal tax rate. So our tax situation got significantly worse when we find ourselves on the single side of this tax bracket pyramid, because our income for the most part didn't go down. And now we're subject to much less attractive rates that have roughly half of the tax bracket threshold as you would face on the married side. And now your marginal rate is 35%. The other planning idea I like to bring up in this type of situation is what happens to the money when we're both gone. And so when we project out these required distributions, even though we're taking significant money out, that still leaves us with a few $1 million left in retirement accounts. And generally speaking, that money goes to the next generation. It goes to kids. Not always the case, but if we're operating under the assumption that that's what this couple is going to do, is they're going to leave it to maybe their two smart, successful children. What happens in that case is those children are subject to a 10-year rule that they have to take the money out. And so if we say each kid inherits $2 million, for example, and each kid is smart and successful and maybe in the 24 or 32 or some higher bracket on their own, they have to take out roughly $200,000 per year on top of their income. And they're going to be subject to whatever tax rate or rates that money falls into on those distributions as well. And so not only can large retirement account balances be call it a tax time bomb for you and your spouse during your lifetimes, it can also be a tax time bomb for your children when they inherit the money, if they are making good money on their own as well. And so if you're compelled by the argument that I've made for this couple as to why it may not make sense for them to pay no taxes on $148,000 of income, you may be wondering, well, what do I do about it? And so I'll bring up the most common planning concept that we will look to consider in this type of situation, which is a Roth conversion. So with a Roth conversion, what we do is we take some of the IRA money, we flip it over to Roth, and we intentionally pay taxes on whatever amount of money we move over. It gets taxed as ordinary income. But that makes that money, one, tax-free forever, so we can access it whenever we want to, and we pay zero taxes as long as we've met any aging requirements associated. Two, it's not subject to those required distributions that we were talking about, so it helps reduce future required distributions that we may face. And three, when it's inherited by the next generation, they still have that 10-year rule, but they can leave the money in the account for 10 years and take out whatever the sum that it grows to, totally tax-free at that point in time. And so generally speaking, when we're working with a client and this type of situation presents itself, what we do is we start with what is their current tax situation. So we analyze their tax return. We look at their needs for the year, like how much do we need to feed them to cover their lifestyle this year, and what sort of income are we going to be forced to realize in the process of doing that. And then from there, we can pretty accurately come up with a number that makes sense for us to convert to help reduce those future required distributions and that future tax time bomb, so to speak. And we can also do it in a managed tax situation where maybe we're looking to do a Roth conversion to the top of the 12% bracket, for example. And we know, hey, we can potentially convert, call it $100,000, $120,000 this year, and that'll get you to the top of the 12% bracket. And here's the tax bill that's going to be associated with that sort of Roth conversion. And we use some of the money in the taxable investment account to cover it, but we go through that process year in and year out as the tax situation changes, as tax rates change, as their overall picture changes, to help reduce their total lifetime tax bill. If you found this video helpful, I'll bring up a couple things. One, down below, please feel free to click the subscribe button where you can watch more of these financial planning videos as we produce them. Second, if you find yourself in a similar situation to the one that we just outlined and you haven't kind of looked at the numbers and walked through this sort of example before, there's a link in the show notes where you can schedule a time with a member of our team where we're happy to have a conversation with you to talk through your situation, how Social Security and required distributions and some of the things that we talked about may impact your total lifetime tax bill, and some of the considerations that we'd bring up on how to manage that. So doing a solo episode today. So with that, I will go ahead and wrap us up by reminding you to rebalance until rich. Cheers. Thanks for tuning in.